What Marty was referring to was the fact that down here in Austin for South by Southwest, I am known primarily as an angel investor, as a startup entrepreneur, as the author of a couple of New York Times best-selling books on how to be a startup entrepreneur, how to be an angel investor, and stuff like that. But my deep, dark secret is that at heart, I'm actually a real estate capital markets guy, which I'm not even sure Marty knew. So my family has actually been in real estate for over a century, and I was born into it. And my undergraduate degree is in urban planning, and I worked for Senator Moynihan as his urban affairs expert. I spent a decade in real estate development, and these days I'm working on something really interesting, which I think you will get a kick out of from multiple perspectives. And it happens to tie in very well with what you just heard from that last great panel, which is all about real estate and why you should invest in real estate and where you should invest in real estate. And what I'm going to talk about today is actually how you invest in real estate. Let's take a look, there we go, at this. So the question is, so how you invest in real estate is a function of your check size to a large extent. If you are a retail investor over there on the left side of the screen with a relatively small check, you're not buying an entire building, you're not even buying part of a building. What you're investing in is a publicly traded REIT, which is liquid as much or as little as you want, and then the REIT managers go out and buy buildings. Or if you have a little more cash than that and you're an accredited investor, you can begin to allocate to funded funds. And again, you're putting in whatever amount you want, and somebody allocates that to other pickers who go out and invest in real estate. If you have a lot of money on the far right-hand side of this market chart, where you're a sovereign wealth fund or a major institutional investor with billions of dollars, you can effectively buy whatever you want. You can go out and buy entire properties and invest in a number of different vehicles. When I was in real estate development, our firm built one financial center in Boston, and our partner there was Metropolitan Life Insurance Company. When we built Pentagon City in Washington, our partner there was Sumitomo. So these guys can own direct properties in there. But what's really interesting is where I think most of the people at this conference are, and that is this big, large center. And the question is, how do people with moderately big size checks, family offices, high net worth individuals, smaller institutional investors, and the like, where do they invest? And typically, you'll be investing, I'll be investing in either non-traded REITs and privately held real estate funds, as you've just been hearing about, or in individual properties through real estate syndicates. And that is where USREM, the US real estate market, is setting out to cross the chasm and enter the market and provide the venue for making investments into real estate that you just heard about that you should do. And it turns out that this venue is actually pretty big. Real estate as an asset class is the world's largest asset class. And in the US, if you look at all real estate investment, professionally managed real estate, and you cut out the publicly invested real estate, the REITs, and you cut out the stuff that is owned and occupied by the user, Apple's campus or whatever, and you even cut out real estate that is owned entirely by one owner. And what are you left with? You're left with real estate that is managed by real estate professionals, but invested in by passive investors. So private investment, professionally managed real estate. And it turns out that that is a non-trivial market. There is over $2 trillion of that in the United States. So that's a market worth making efficient. And that's what we're doing. As a quick refresher, for the few people here who might not be familiar with how real estate investment works, typically in a real estate syndicate, a sponsor or a general partner, the real estate expert, decides on a property to acquire for investment, or if it's a developer, they're doing new development, they will build a building. They go out and they debt finance the majority of the cost of doing that. Typically for these syndicates, it's about 65%, it can be 60 to 70%. So they'll go out and they'll get a 65% loan to value ratio loan on that, which means they have to somehow come up with the 35% of the value in equity. And so what they do then is to create a syndicate, as you know, a special purpose vehicle, where they put in 10% of that amount, or typically, 3 to 5% of the amount of the property. And then the rest, 30 to 35%, they have to go out and raise from limited partners. And who are those limited partners? It's basically everybody on this call. It is the typical family office that is allocating 25% or more of its assets to real estate as a relatively secure, high return investment over time. And typically, on average, limited partners will be investing in the hundreds of thousands to low millions. I would say the sort of sweet spot in the center of the bell curve is probably 250,000 to 5 million, but it can go as low as 50,000 or 100,000, some funds or properties, and as high as 10 or 20 million if you're a very well-heeled play. And so there are all of these investments into real estate have one thing in common. Real estate is an illiquid asset class. And what that means is that as an investor, as a limited partner investor in these properties, the only thing you can take to the bank is that you can't take it to the bank, is that you cannot sell your interest because real estate is illiquid. You invest, the GP, the sponsor will tell you that they are pro-forming this investment for 5 years, 10 years, 15 years on a closed-end fund, after which they will sell the property and you'll get back your cash along with the appreciated value. But in between then, you'll be getting annual or quarterly distributions from the net operating income. But until the end of the maturity date, you can't sell your interest. And you know that going in, and they know that going in, and everybody knows it going in, because that's the essence of private investment in real estate. However, sometimes, despite everybody's best intentions, life happens. And in the US, life happening often means you get divorced, or you die, or you have a margin call, or you get a capital call from somewhere. And all of a sudden, the LP says, I have a real need for liquidity. I've got to get some cash, and I have this big chunk of real estate over here. So I really need to turn that into cash, even though that wasn't the original intention. And that's a real problem because they're not allowed to sell their interest. But interestingly, the flip side of that is also a problem for the GP, the general partner, because while the LPs can't sell before their time, when the time comes of maturity date, the GP must sell the property in order to return the cash to the LPs. But what happens if the GP sees this maturity date come into a market that, like right now, is not a very good market to sell into, but if they can only hold for a couple of years, they will be able to sell a profit for everybody. So that's a problem for them. So the fact that real estate is illiquid is a problem for both the GPs and the LPs. So what happens in these scenarios where somebody needs liquidity? Well, in the case of the LP really needs liquidity, goes to the GP and says, hey, I know that the deal was I wouldn't take it out until the end of the maturity date, but I really need cash now, so please buy me out. And if any of you happen to be GPs of real estate syndicates, you know what the response to that is. It is, listen, I empathize, I'm sorry, but that's not the way it works. No, I can't buy you out. And if the LP really needs to go liquid, they will jump up and down and stamp their feet. And ultimately, the GP will say, okay, I'm not going to buy it from you. I can't do that. That's not my business model. But if you can find somebody to step into your shoes, I will okay the transfer. And so at that point, you now have a random person, a random LP, trying to sell their random piece of a random real estate syndicate for which there is no easy market. And the only people who are going to buy that are secondary funds. And these secondary funds are not buying because they love the property. They're buying because they know the seller is in really deep doo-doo and they can get an enormous haircut, often 20, 30, 40% discount off of net asset value on this property. On the other hand, for the GP, if they come to the end of the string and they have LPs who have to be repaid, they have often no choice but to do an LP replacement, or what's known as a GP-led secondary, where they have to go out and find new LPs to come in and take out their prior LPs. And that by itself is A, tough, B, they're doing it at discount, C, it costs hundreds of thousands of dollars, and D, it can take up to a year to get all the paperwork done. The bottom line on all this is that nobody ever wants to sell a real estate secondary. There was never any real estate asset put up for sale as a secondary because somebody wanted to do it. So given the fact that nobody wants to do it, you want to take a guess as to how many dollars changed hands in US real estate secondaries in the past 12 months? The number is going to surprise you. $20 billion, which goes to show you that sometimes life really happens and you got to get out, So what's going to happen? What do you do about this? Well, it turns out that real estate, the world's largest asset class, also sort of a stick in the mud asset class, real estate hasn't appreciably changed in the way we invest in the last 50, 60, 80 years. And so a number of the major real estate players on the East Coast got together and said, okay, something's going to change. We know there are going to be some innovations here in the market, and it might as well be us who changes it rather than let some young tech whippersnapper or whatever come in and try and do it. And so for those of you who are either LPs or know the East Coast real estate market, our seed funders at the U.S. real estate market are the biggest names in real estate: the Roses, the Rudins, the Seckendorfs, the Manicherians, the Galbraiths. Robert Enton is the CIO of Vornado. Jeff Berman is the CEO of Camber Creek Ventures. Howard Morgan, co-founder of First Round Capital. These are major players. And so they seed funded us to create the U.S. real estate market. And we put together an incredible founding team. I am actually the full-time CEO operating and running the company. Lizanne Galbraith, our president, was the CEO of Galbraith and Companies, one of the nation's largest developers. They developed the Trump International Hotel on Columbus Circle. Lizanne was actually eventually merged her company into LaSalle Partners and then took it public to JLL, so she was in the board of JLL. The rest of our team, equally illustrious: Shashi Shah created and ran a $28 billion AUM hedge fund in the UK. Ray Khan, who's our head of markets, used to run the Creditex exchange for the New York Stock Exchange's parent. Our head of real estate is actually my daughter Lauren, a fifth generation real estate player. Our head of marketing is Christian Vanderbroek, who was the head of government affairs and international relations at the New York Stock Exchange. And our head of sales is Marco Rosa, who is a long experienced sales guy. So given this extraordinary management team, the only thing that could be better than this is actually our advisory board. I'm not going to go through everybody's bios in detail. Just suffice to say, among the advisory board, we have the former chairman of the Securities and Exchange Commission, the former CEO of Dun & Bradstreet, the world's leading monetary policy economist, the former head of Citigroup's Global Wealth Management, the former executive vice president of the New York Stock Exchange, legendary real estate developers. It's a heck of a team. And so what we are doing now is, after a long gestation, bringing to market the U.S. real estate market. So what the heck is that? Well, you just heard in the last panel all the reasons you should be investing in real estate. And put me up on screen.
You are up.
Oh, great. Okay. So if you want to invest in real estate, you saw all the things that you should be doing. But now, where do you find them? Well, if you happen to be on somebody's list and they show you their new deals as they're getting them, that's fine. But what if you're not? And how do you get into existing syndicates that have not been publicly made available? And so what we're doing is we are creating effectively this marketplace, this supermarket for grown-up, real, serious, big check investors who are investing with the nation's leading sponsors, leading real estate developers across the entire spectrum of multifamily residential, of workforce housing, as you heard, of hospitality, of single asset, triple net retail, of industrial, factory, distribution centers, everything you want to do. This is designed for serious, large-scale investors. So you're talking about people who are writing $100,000 minimum check size, typically more than that. And so you come onto the site and you register. We ask you for all your stuff. This is not a crowdfunding platform. This is for serious family offices and H&W investors. We then do full-on checks. We owe this to all of the sponsors we're bringing in, who are the creme de la creme of sponsors. And so we make sure that you pass all the know your customer, anti-money laundering, and so on and so forth. And then you have access to the platform. And here you can now go and search on whatever it is you are looking for, right? So are you looking for workforce housing? Are you looking for luxury residential in New York? Are you looking for, detached single family home collections in Texas? Whatever you do, you put in your parameters here, and then we give you back a listing of these are all the things in the platform. These are currently things that are live on our platform, properties that might be of interest to you. And you can see if it's a new syndicate, the projections from the sponsor, if it's an existing property, what the current cash flow is. And so you click on something and it takes you to a full listing for the property. And this listing has all the information from the sponsor, all the information from their deal room, from their offering memorandum, from their marketing site. You can have access to their deal room by going through an NDA. You can view their videos and all their projections over here. And ultimately, at the end of the day, being fully informed about the property, you can then say, okay, I am interested in investing X amount at these numbers. And so you put in the amount you want to invest and you click, hello, and we go in and we then introduce you to the sponsor. And the sponsor basically now has somebody delivered to them who has seen the entire thing, read all the information, is a sophisticated investor, and is looking to invest this amount in that property. And so this is for a primary syndicate that the sponsor is putting together, which is great. But that's not where it stops, because the real power of doing this is what happens after the syndicate is completed, after they sell all the pieces here. Because then what we do is we go with the sponsor to all of the LPs, all the limited partners who are part of this syndicate, and this can happen even if they didn't put the syndicate on our platform to start with. We go to every one of these LPs and we say, okay, you invested $1 million in this property. Out of curiosity, at what number might you be interested in entertaining an offer for your interest? If somebody offered you $2 million, something you paid $1 million for, would you want to hear about it? I assume so. Somebody offered you $100,000 for something you paid $1 million for? I assume not. But whatever it is, you put in that number, and then everybody goes about their business, and it's exactly business as usual, the way the world works now, except the LP knows that if somebody comes along who is interested in that property on those metrics, and they want to make an offer that is above what they're looking for, they will get it. Because now, with everybody having given us their number, and we have all the information from the GP, so we know who has what the interest in the property, what they paid, what the NOI is and stuff on the property, effectively, we now have established an implied cap rate, right? So that we know every single existing owner of the property is prepared to sell, or at least interested in getting an offer at these kinds of numbers. And this is held confidentially. This is not broadcast. Nobody knows what your number is. Not even the GP. The GP in aggregate sees the total amount of interest there, but they don't see what each individual LP is looking to do. That's only kept behind in the system, because now we keep that listing, the original listing, up, all the information from the GP as updated by their quarterly and annual reports. So you have all the data in the data room about the NOI and everything else. But now, instead of the projections from the GP, you now have the existing cash-on-cash cap rate. So you can see, based on the value the GP is carrying it at, right now, given the NOI, current last 12-month NOI, what this property is throwing off. And so now you, as an LP, can go shopping effectively for all of these properties, new ones and existing syndicates, and say, hey, I like this. This one's showing currently at 7.7%. Hey, you know, if I like that, good, I'll put in an offer of $1 million or $500,000. But what if I like the property, but my minimum is I need an 8.5% return, not 7.7? Well, that's a little slider under that 7.7, and you can move the slider to 8.5, and you can effectively put in a bid, and you can say, hey, I'm interested in investing $1 million in this property for an 8.5% return. And so what do we do then? We then take that and we go out to all of the existing LPs who've indicated an interest at that number, and we say, hey, we have a potential offer to acquire X amount of your interest at this number. And if they say yes, we then connect the two of you up, we help facilitate the transaction, and everybody's happy. The LP has sold, the new investor has bought something that wouldn't have been available before, nobody's yelling at the GP. In effect, this is actually a win-win-win for everybody, because new investors are making their decision to buy not based on the distressed quality that the seller has to sell. They're making their decision to buy on the basis of what they think this particular property and its cash flows are worth. The LPs now who are in the property have a continuous opportunity to sell by simply changing the price at which they're prepared to accept an offer. And the beauty of that is that now there's something called the liquidity premium in real estate. There have been multiple studies that have shown that the value of the exact same building, one that's liquid and can be sold versus one that is illiquid and can't be sold, is between 12 and 20%. Which is actually logical when you think about it, because if you can do, you have two opportunities, and when you can't do something and when you can, the one that gives you the optionality is worth more. So therefore, by making these real estate interests available for sale, we've now added to the liquidity value of the real estate of the property, makes it more valuable to the GP, more valuable to the LPs, and everybody's happy over there. And so now you have a win-win scenario. And the only thing we need to make this work is the fact that we need to be a broker-dealer, because you can't take commissions unless you're a broker-dealer. So we have actually found a broker-dealer. We are assigned to acquire a broker-dealer known as Second REIT, which is a fully SEC-registered BD. We're putting in the continuing membership application next week. And so within 90 days or so, we should be available and able to fully transact these businesses, all of these sales from on the platform. Now,
about 5 minutes.
Yep. So now that would sound like a pretty interesting play, giving liquidity options for sale to real estate investors. But to quote Steve Jobs, there's just one more thing, because now that we have all of the LPs and all of the GPs and all the information about the property, we have done a deal with a partner known as Liquid LP, and what they do is they lend money backed by a giant hedge fund. They lend money on illiquid assets. So they are underwriting every one of the properties on the platform, and they are having a standing offer available to every LP on the basis of their LP interest, saying you can borrow X amount based on this thing without in any way encumbering the property, filing a lien, affecting the GP or the partnership. It's just the LP interest that is you're putting up. And so therefore, you can now borrow against your interest in this property. You can sell it, and we're working with another party who is a more traditional secondaries fund who's interested in putting in a buy offer, not a particularly big discount, but a buy offer for everything on the platform. And the result then is that you've got a super dashboard for the LP showing what they've acquired, showing what they paid for, what they have decided to list out or to get offers from on that, what they can borrow against it, what they can sell for. And we've now provided liquidity for all of these hitherto illiquid assets in commercial real estate designed for family offices and HNWs. And so we've been doing this now. We're going live, hopefully in about 90 days, as soon as we clear the SEC. But even before then, we have had close to $1 billion of interest from GPs, from leading GPs around the country, across a wide range of properties. And we'll be open for business and would love to have anybody who was interested at that point reach out to us and talk about either working with your GPs of your existing properties to make it liquid or acquiring new LP interests across the board. So that's what we're doing, and I would be delighted to talk to anybody about that. Thanks so much.
Do you have any capacity statements? David's great. Last question. Okay, you have a question.
Sure. Question.
The UX looks great. Curious, with the $20 billion, I assume that was, if you think of a bid-ask spread, that was probably at the bid, I would imagine.
No, the $20 billion was the amount that actually changed hands.
Okay, was that also kind of the low range? Because people tend to sell when they need to, especially in a down.
Yeah, people sell when they need to. So that $20 billion is something on the order of, I think, the 1.5% to 2% of stuff out there, and is effectively all discounted sales because there's not liquid. The buyer can't then resell it, right?
What do you prevent the aggregate fair value?
Typically, secondary sales in real estate are anywhere from 20 to 40% off of NAV. I mean, even a really prime, great property, if it's still locked up and the buyer can't sell it as of right, it's an encumbered property, right? So even if everything in the property is perfect, it's still distressed, right? So that's why you're going to be at least 20. And if it's something like some of the sort of secondary stuff, housing we were talking about in the last panel, it can be up to 40% if there's not a great new market for it.
What's the threshold for an investor, an accredited, qualified purchaser?
Sorry, you'd have to shout. I can't hear you.
What's the minimum threshold for an investor? Is it accredited or is it higher?
It's up to the GP. So we have some GPs who are only dealing with qualified purchasers, which is 5 million. Our initial thought when we go live is to allow accredited, but since the minimum ticket size is 100,000, if you're investing 100,000 in a property, you really had better be a qualified purchaser. So we may end up just saying the entire site is just for qualified purchasers. Anybody else?
I did have a question.
Yes.
So my question is, we have had syndicates galore coming to us for the last 10 years of guys who overextend themselves. Actually, a lot of them were in Texas, of guys who they were too small to be developers on their own. So they said, great, let's build a team of 50 people. And we'll all put in, and there was nobody taking up rescue the investment, right? So my question is, how many of these are out there? Poorly, ill-formed.
How many syndics out there? There's $2 trillion in investment in professionally managed real estate. There is an enormous amount. I mean, literally, this is a drop of. I mean, we are going to go live with 1 to 2 billion of property on the platform before we even started. There is a virtually unlimited. I mean, you're talking literally billions and billions because this is in the United States how real estate is financed.
Ron Davari, he used to run BlackRock.
Oh, we know I know Ron very well.
Yeah.
My name almost ended up on the book. No, I have a big admiration for the team. I know many of them.
It's a great team.
It's a great team. It's you guys have been in this startup world and capital markets and whatnot. The question is, I've seen a couple of iterations of this. Under this scenario, do you need to be, for the platform to be a BD?
Yes, Absolutely, and that's why we're requiring second read. We
So
will
this
90
is
days.
under FINRA.
Absolutely, we will be a fully SEC registered. We are acquiring a fully SEC registered platform, filing the application this week. So within 90 days, probably we will be a live BD. Absolutely,
Right.
positively.
What's the fee structure? What?
Fee structure is straight up commissions. So it'll typically be 2 to 4% on initial placement, and 4 to 6% for secondaries. That's it.
What has happened is a lot of people may or may not have followed real estate syndication. SEC came in as a fractional security. And so even some of the biggest real estate businesses had to revamp their business and their model. They can't just sell equity without fractional equity. But the second question, are you still doing the private single property REIT? Or
So Ron is mentioning, and Ron's been following us for a while. We have literally been putting this thing together for close to 4 years at this point. And given our background, the extraordinary background on the management team, we have looked at every asset. We are blockchain experts, securities experts, real estate experts, and we have tried absolutely everything. And it turned out that while these were brilliant ideas and great plans, the real estate world is anathema relative to blockchain. Nobody wants to touch blockchain with a 10-foot pole. Nobody wants to recut the structure for their things into a single asset REIT, as we were originally looking to do. So what we ended up doing was working with existing LP structures exactly as they are. The only change that is required in an existing structure is where in the subscription docs it says the purchaser is not allowed to sell without the approval of the GP. We just put a comma, except through the US real estate market. And literally, that's it. The GP pre-approved sales for US REM, and every single thing else is exactly the same, no change, which is why we can do this, which is why we are getting literally every single GP who has seen this presentation in the last 6 months has either signed on the dotted line or said, talk to me, I want to come do this on my next deal. It's really that, it is that much of a breakthrough in a completely different way of approaching the market.
thank you.
Fantastic, great.